A comprehensive look at trends, fund profiles, and more in Exploring ETFs.
ETFs have become increasingly popular, and the popularity goes on. Doesn't seem to be waning at all. Our ETF Research Director, Nina Mishra, is here to tell us all about it. So you've got the actual numbers, right? The
Yes.
ETFs are overtaking the hedge funds in popularity.
Yes, at the end of the second quarter this year, assets in the global ETF industries surpass those with hedge funds. And I think it is a major milestone for the ETF industry, which is just about 25 years old, whereas hedge funds have been around for more than 66 years.
Yeah.
And this chart, this is from the London-based ETF consulting company, ETFGI. This shows how ETFs have been gaining assets at a faster pace compared with hedge funds, particularly since 2008. At the end of 1999, assets in the global ETF industry were just about 10% of assets with hedge funds. And whereas at the second quarter, they have exceeded those with hedge funds.
Yeah, this is an interesting story here. Why do you think this is?
I think reasons are not very difficult to understand. ETFs, in fact, most ETFs are low-cost, transparent, tax-efficient products that track an index. And they are very low cost, as I mentioned. Most ETFs charge less than 0.5% in annual expenses. And there are many ETFs which are really, really cheap, charging less than 0.1% in annual expenses.
Wow.
And hedge funds, on the other hand, they use a variety of mostly complex strategies, and they aim to outperform the market. And with the same outperforming the market in all sorts of market and environment, they charge a much higher fee, usually 2% of annual fee and 15 to 20% of performance fee. But their performance has disappointed investors, mostly in recent years. In the past few years, the broader hedge fund industry, as measured by the Hedge Fund Industry Index, has underperformed the S&P 500 index. Some hedge fund managers have done very well, only a handful of hedge fund managers, but the broader industry hasn't done well. And that is the reason why investors are not happy with hedge funds. They pay a lot and then they don't get good performance. On the other hand, US stocks, as you know, have done very well over the past 6 years. And all the stock ETFs tracking the US stock market, particularly the ultra popular ones like S&P 500, Spider ETF, SPY, and the Vanguard S&P 500 ETF VOO, they have become very popular with investors due to their very low charges and transparent structure.
So does this trend say something about investors' appetite for risk?
Investors do not want to take risk. If there is a product available that tracks the market and market is giving a good performance, then why go with hedge funds, which are riskier, which employ riskier strategies and still underperform the market? But for investors who are still interested in hedge funds, there are some copycat hedge fund ETFs.
Oh.
They borrow the best ideas from hedge fund managers, and in fact, they have done better than the hedge fund industry and even better than the S&P 500 index over the past few
So you have
years.
a couple of examples of different ETFs for us. Which are these?
Yes, these are both copycat
They are.
ETFs. So the first one is Global X Guru Holding Index ETF. The ticker is Guru. It uses the best ideas from a select pool of hedge funds using their 13F filings on a quarterly basis. It was launched in June 2012, has about 240 million in assets under management, charges 75 basis points in expenses.
All right. And the next one is Alpha Clone?
Yes, and the ticker is Alpha. This also uses a proprietary clone score methodology to aggregate the best ideas from hedge fund managers. This was also launched around the same time in May 2012, has about 198 million in assets under management. Slightly pricier, it charges 95 basis points in expenses, but it has a unique thing that it has a built-in hedging mechanism within the index. So when the S&P 500 index goes down, then this ETF goes from long only to hedge with a 50% short exposure to the market.
I see.
And this has done slightly better than the other one.
So if you're comparing the two, over
Yes.
the past 3 years, what do we have?
So I have compared these two ETFs, the Guru and the Alpha ETF, with the broader S&P 500 ETF, which is represented by SPY. And I have used the 3-year period because both these ETFs have been around for just a little more than 3 years.
Okay.
And as you can see, both of them have outperformed the S&P 500 index. Guru is up about 77% and Alpha is up about 78%, compared with about 59% return for the S&P 500 ETF.
Okay, do you own either one?
I don't.
All right, well, thanks for spotlighting that trend for us. So you have to keep an eye on it. Maybe we'll do a follow-up here going forward sometime.
Sure, sure.
In the meantime, if you would like more information on ETFs, commentary, articles on specific ETFs, find it all in the ETF section of Zacks.com. And you can access it very easily just by going to our homepage and using the Funds tab in the top toolbar. Now, you know, you can watch these videos in a variety of different places on a variety of different platforms besides Zacks.com. If you happen to be watching these videos on YouTube, you can always subscribe to them and comment on them there. With Nina, I'm Terry Ruffalo.